Picture this moment, November 2025, and you're watching Nvidia hit another all-time high. Your portfolio is finally green after months of waiting. The AI revolution feels unstoppable. Tech analysts are calling for even higher targets. Then you discover something that changes everything. Stanley Druckenmiller, the legendary investor who turned $12 million into $12 billion, the man who predicted this entire AI boom back in 2023, just filed his quarterly 13F disclosure with the SEC. You scroll down to his Nvidia position, expecting to see millions of shares. Instead, you see a number that makes your stomach drop. Zero, not a trim, not profit-taking, complete evacuation. While you were buying the rally, he was executing the exit. And here's what should terrify you about the timing. By the time you're reading about his sale in the news, the transfer of wealth is already complete. His billions are safely in cash or repositioned elsewhere. Your money? It just became the liquidity he used to get out. Let me explain why this isn't just another billionaire taking chips off the table. This is the smart money ringing the bell at the market top. And most investors are completely missing the signal. You've probably heard the comfortable narrative from financial media. Druckenmiller is just locking in profits after a great run. He's rebalancing his portfolio. This is normal position management. These explanations sound reasonable until you understand how Druckenmiller actually operates. This is a man who held Amazon through the entire 1990s, watching it surge hundreds of percent. He held Facebook for years during its dominance. When he finds a genuine paradigm shift, he rides it until the fundamentals change. He doesn't sell winners just because they went up. He sells when the story is broken. Think about what his zero balance really means. According to SEC filings, Druckenmiller's Duquesne family office held substantial Nvidia positions throughout 2023 and into 2024, riding the AI chip explosion that he publicly predicted. Then, in Q3 2025, he methodically dismantled the entire position. This isn't a trader taking quick profits. This is a macro strategist who sees the paradigm ending. Here's the mechanism you need to understand. When billionaire fund managers want to exit a massive position, they face a brutal problem. If Druckenmiller announced on CNBC tomorrow morning that he thinks Nvidia is overvalued and he's selling everything, what would happen to the stock price? It would crater before he could execute even a quarter of his exit. The very act of selling would destroy the value he's trying to capture. So they use a different playbook. They sell into strength. They sell into your optimism. They sell during the hype cycles when retail investors are rushing in, providing the liquidity they need to get out without moving the price. Wall Street has a term for this phase: distribution. The smart money distributes their shares to the public while everyone is still celebrating. You see this pattern throughout market history. Let me walk you through the most relevant comparison because Druckenmiller has literally done this exact move before. Remember the dotcom bubble? In 1999, technology stocks were soaring on the promise of the internet revolution. Sound familiar? Druckenmiller rode that wave brilliantly, making billions for George Soros's quantum fund. He understood the internet would change everything, and he positioned early. But here's the crucial part. In late 1999 and early 2000, right as the bubble reached its peak euphoria, he started liquidating his tech positions. Not because the internet wasn't real, but because the valuations had detached from reality. The Nasdaq topped in March 2000. Within 2 years, it fell 78%. Druckenmiller wasn't caught in that collapse. He had already switched sides. Now, look at our current moment. The AI revolution is real, just like the internet was real in 1999. Nvidia's chips genuinely power the infrastructure that's enabling this transformation. But here's what Druckenmiller sees that most investors miss: the difference between a real technological shift and sustainable stock valuations at that particular moment in the cycle. When he walked away from tech stocks in early 2000, pundits criticized him. He's missing the new paradigm. The internet changes everything. They were right about the technology, but catastrophically wrong about the timing. The investors who believed the hype and held through the crash lost everything. The investors who followed Druckenmiller's lead preserved their capital and bought assets at 90% discounts 2 years later. His Q3 2025 exit from Nvidia is the same historical rhyme. He's seen this movie before, and he just walked out of the theater before the tragic ending. Think about what this means for your portfolio right now. If you're holding Nvidia or other AI plays, you're essentially making a bet that you understand the technology sector better than someone who's been doing this for 40 years, who has access to information you'll never see, who talks to CEOs and policymakers directly, and who has successfully navigated multiple bubbles and crashes. You're betting that when he says "I'm out," he's somehow wrong about the timing, and you're right. That's possible. But let me share what the odds look like historically. According to research from the National Bureau of Economic Research, when legendary investors with 30-plus year track records make dramatic position changes, their timing is correct roughly 70 to 80% of the time on a 12-month forward basis. These aren't wild guesses. They're informed decisions based on private information flows, pattern recognition from decades of experience, and access to analysis that retail investors simply cannot match. You're not competing on a level playing field. You're reading about his trade months after he executed it, making decisions with delayed information while he's already positioned for what comes next. Here's the other critical piece most people miss about these insider exits. Druckenmiller can't just tell you directly that trouble is coming. If he went on television and said, "The AI bubble is about to pop, everyone should sell," he'd face regulatory scrutiny and potential legal liability. So, the smart money communicates through actions instead of words. Their 13F filings are the closest thing we get to a direct warning, but only if you're paying attention and understand what you're looking at. His zero balance in Nvidia is a flashing red alarm. While he was selling throughout Q3, what was happening in the media? Analysts were raising price targets. Tech influencers were celebrating new highs. Retail investors were pouring money into AI stocks, convinced they were buying the future. That divergence, smart money exiting, while retail money enters, is the classic signature of a market top. You might be thinking, but Nvidia's earnings are still strong, revenue is growing, the AI build-out is real. All of that can be true while the stock is still dramatically overvalued. Druckenmiller isn't questioning whether AI matters. He's questioning whether Nvidia, at current prices, offers attractive forward returns compared to the risks he sees building in our economy. And that's where this story gets much darker, because when you look at what else he sold and where he moved his money, you realize his Nvidia exit isn't an isolated trade. It's part of a comprehensive defensive repositioning for what he expects in 2026. This is a man preparing his entire portfolio for a storm that most Americans don't even see coming yet. The distribution phase is complete. The smart money is out. And we're about to discover what happens when retail investors are left holding the bag at the top of the most expensive tech market in American history. Now, let me show you why this goes so much deeper than one stock trade. When you examine Druckenmiller's complete Q3 2025 portfolio changes, you discover something that should make every tech investor pause and reconsider their entire strategy. Nvidia wasn't the only casualty. According to his 13F filing, he also liquidated his entire position in Palantir, another AI darling that Wall Street analysts have been praising for months. He slashed his holdings in multiple high-growth technology names across the board. This isn't a company-specific concern about Nvidia's competitive position or Palantir's government contracts. This is a systematic purge of the entire growth in AI sector from his portfolio. Think about what that pattern reveals. When a legendary macro investor exits one overvalued stock, you might call it profit-taking. When he exits an entire sector simultaneously, he's making a statement about the macro environment. He's telling you that the fundamental conditions that allowed these stocks to soar, cheap capital, loose monetary policy, euphoric sentiment, are about to reverse violently. You want proof this is a defensive macro play? Look at where the money went. While Druckenmiller was dumping his AI positions, he was simultaneously building positions in gold mining companies and precious metals equities. For those unfamiliar with how billionaire investors think, this rotation is screaming a very specific message. Gold and gold miners are classic defensive plays that outperform during three scenarios: high inflation, currency debasement, or financial system stress. When someone with Druckenmiller's track record moves billions from high-beta tech stocks into inflation hedges, he's preparing for a hard landing or stagflation scenario in our economy. He's moving from paper assets to hard assets, from speculation to preservation, from offense to defense. According to data from the World Gold Council, institutional investors increased their gold allocations by the largest percentage in over a decade during 2025. Druckenmiller isn't alone in this trade, but he's among the earliest and most aggressive. The smart money is building bunkers while retail investors are still dancing at the party. Now, let me explain the specific catalyst that likely triggered his exit, because this is where the story gets mathematical and unavoidable. The AI boom created a massive capex cycle. Companies like Microsoft, Google, Amazon, and Meta have collectively spent hundreds of billions of dollars building AI infrastructure over the past 2 years. They're buying Nvidia chips by the truckload, constructing massive data centers, and racing to deploy AI capabilities before their competitors. That spending drove Nvidia's revenue to record highs and justified its trillion-dollar-plus valuation. But here's the problem that Druckenmiller sees coming, what Wall Street calls the ROI cliff. These companies spent all that money on AI infrastructure with the expectation that it would generate enormous returns through new products, cost savings, and competitive advantages. According to recent surveys from McKinsey and Goldman Sachs Research, most enterprises are still in the experimental phase with AI. They haven't seen the productivity gains or revenue generation that would justify the continued massive spending. Think about this from a CFO's perspective. You've spent $50 billion on AI infrastructure over 2 years. Your shareholders are now asking, where are the profits? When does this investment start generating returns? And if the honest answer is, we're not sure yet, but we need to keep spending billions more, how long before the board starts asking harder questions? Druckenmiller sees the cliff approaching where big tech stops buying chips at the current pace. Maybe they don't stop entirely, but if the orders decline by even 30 to 40% as companies pause to evaluate their AI investments, what happens to Nvidia's growth story? The stock is priced for perpetual acceleration. Any deceleration gets punished brutally by the market. According to financial models from analysts who actually read the footnotes in these tech company 10K filings, we're approaching a natural pause point in the AI infrastructure build-out cycle. The initial wave of spending is largely complete. The next wave depends on proving that the first wave generates returns. And if that proof doesn't materialize in early 2026, the buying stops and Nvidia's revenue growth craters. That's the mathematical trap. Druckenmiller isn't predicting that AI fails as a technology. He's predicting that there's a gap, potentially a year or more, between the infrastructure spending phase and the monetization phase. During that gap, Nvidia's stock price could easily fall 50% or more as investors reprice the company based on declining growth rates rather than the perpetual acceleration they'd assumed. He's not willing to sit through that drawdown, so he left before the music stopped. But here's what should really concern you about the current moment. Druckenmiller isn't making this move in isolation. When you zoom out and look at insider selling across the entire tech sector in 2025, you see a coordinated exit by the people who know these companies best. Jeff Bezos has been selling Amazon stock at a record pace throughout 2025, unloading billions in shares. Mark Zuckerberg has been systematically reducing his Meta holdings through pre-planned trading programs. According to SEC filings compiled by insider tracking services, aggregate insider selling in big tech reached levels we haven't seen since early 2000, right before the dotcom crash. The executives and major shareholders who have the clearest view into their company's actual performance and forward outlook are heading for the exits. Now, you might hear the counter-argument. These billionaires have to diversify. They have estate planning needs. This is just normal portfolio management. And sure, that's partially true. But here's what the data shows when you dig deeper. The pace and scale of selling in 2025 is 3 to 4 times higher than the average of the previous 5 years. This isn't routine diversification. This is urgency. These insiders aren't just selling a little bit. They're selling everything they can while still maintaining control of their companies. They're taking advantage of near-record high valuations to convert stock into cash at a pace that suggests they don't expect these prices to last. And here's the mechanism that makes this so dangerous for regular investors. When corporate insiders and legendary hedge fund managers are all selling, who's buying? You are. Your 401k is. Your index fund is. Retail investors and passive investment vehicles are absorbing the supply that the smart money is desperately trying to unload. According to data from the Investment Company Institute, retail investors poured over $300 billion into equity funds in 2024 and 2025 combined, one of the largest retail buying waves in history. Meanwhile, hedge funds and institutional investors have been net sellers. The wealth transfer is happening in real time, and most Americans have no idea they're on the wrong side of the transaction. Think about what this sets up for 2026. If Druckenmiller is right about the timing, if the recession or credit stress he's positioning for actually materializes, what happens to all those retail investors who bought at the top? They're holding overvalued tech stocks in portfolios that could easily decline 40 to 60%, while the smart money sits safely in cash, gold, and defensive positions ready to buy assets at bargain prices during the panic. This is how generational wealth transfers happen, not through complex derivatives or exotic strategies, but through basic timing. The experienced investors sell near the top to inexperienced investors who believe the rally will continue forever. Then when the crash comes, the experienced investors buy back those same assets at massive discounts from the inexperienced investors who panic sell at the bottom. Druckenmiller's exit from Nvidia isn't just about one stock. It's about recognizing where we are in the cycle and refusing to be the liquidity provider for the next wave of bag holders. The question you need to ask yourself is, which side of this transaction do you want to be on when 2026 arrives? Let me show you the actual math behind what Druckenmiller sees coming, because once you understand the numbers, his exit makes perfect sense and the danger becomes unavoidable. Right now, as of late 2025, Nvidia trades at a price-to-earnings ratio that's roughly double its historical average. The stock is priced for perfection, assuming perpetual growth, zero competition, and an AI revolution that accelerates forever without pause. Wall Street analysts justify this premium by pointing to the AI paradigm shift, arguing that traditional valuation metrics don't apply anymore. You've heard this story before if you studied the dotcom bubble, where analysts said the same thing about internet stocks. Here's what happens when paradigm premiums evaporate. When investors stop believing in the Yangshu growth story and start demanding traditional fundamentals, stocks undergo what's called mean reversion. They fall back to their historical average valuations. For Nvidia, if we strip away the AI hype premium and the stock trades back to its median PE ratio from the previous decade, you're looking at a price that's approximately 50% below current levels. Think about what that means in dollar terms. If you're holding $100,000 in Nvidia right now, mean reversion would turn that into $50,000. Half your capital gone. Not because the company fails, not because AI doesn't work, but simply because the stock returns to a normal valuation multiple that reflects realistic growth expectations rather than euphoric speculation. Now, here's where Druckenmiller's timing gets really interesting. Markets are forward-looking mechanisms. They don't wait for bad news to arrive. They price it in months ahead of time. Professional investors like Druckenmiller are constantly asking themselves, what will conditions look like 6 to 12 months from now? And when he exited in Q3 2025, he was positioning for what he expects in mid-2026. So, what does he see coming in 2026 that made him exit in late 2025? According to data from the Federal Reserve and Bank for International Settlements, we're heading into what financial analysts call the corporate refinancing wall. Throughout 2020 and 2021, companies borrowed massive amounts of money at historically low interest rates, often below 3% for investment-grade debt. Those loans have 5-year terms, which means they start maturing in 2025 and 2026. Companies now need to refinance that debt, but interest rates today are double or triple what they were paying. Imagine you're a CFO who borrowed $10 billion at 2.5% interest 5 years ago. Your annual interest expense was $250 million. Now that debt is maturing and you need to refinance, but current rates are 6%. Your new annual interest expense becomes $600 million, an extra $350 million in costs that come straight out of your profits and free cash flow. Multiply that dynamic across thousands of companies and trillions in maturing debt, and you see the problem. Corporate profit margins are about to get crushed by higher financing costs. When profits fall, stock prices follow. and the highest valuation stocks with the most optimistic growth assumptions, like Nvidia, fall the hardest because they have the furthest to drop. Druckenmiller sees this credit stress building throughout 2026. His late 2025 exit gives him a 6-month head start before the reality hits earnings reports and market prices. By the time CNBC is discussing the profit warnings and downward revisions in mid-2026, he'll be positioned to buy assets at 50% discounts while everyone else is panic selling. This is what separates legendary investors from everyone else. They don't react to news, they anticipate it and position accordingly. But here's the truly terrifying part that most investors haven't considered, and this is where Druckenmiller's exit becomes a systemic warning rather than just a smart trade. When the crash comes in 2026, the mechanics will be completely different from previous crashes because of who's left in the market. Think about what we discussed earlier. Druckenmiller is out, other hedge fund legends are out, corporate insiders are out. The smart money has spent all of 2025 methodically exiting their positions and moving to cash or defensive assets. So, when the selling starts in 2026, when the recession fears materialize and investors rush to the exits, who's left to buy? There are no whales waiting on the sidelines with dry powder ready to buy the dip, because they already deployed that capital, getting out in 2024 and 2025. The usual stabilizing force in market crashes, the deep-pocketed institutional investors who step in to buy when everyone else panics. They're not coming this time because they're already out. What you get instead is what traders call a liquidity vacuum. It's when there are massive waves of sell orders, but almost no buy orders at any price near current levels. The market doesn't gradually decline. It gaps down violently as each price level gets exhausted instantly, without any meaningful buyers appearing. According to studies from the Bank for International Settlements, liquidity vacuums during crashes can cause 20 to 30% drops in single sessions when market structure breaks down. Picture what that looks like in practice. You wake up one morning in mid-2026 and Nvidia is down 15% pre-market on recession fears and weak guidance. You think, I should probably sell, but you tell yourself it's just a temporary pullback. By the time markets open, it's down 22%. You try to sell, but your order sits there because there are no buyers at that price. The price drops to minus 30%, then minus 40%, and you're watching your life savings evaporate in real time while you're unable to exit because there's no liquidity. That's what happens when the smart money exits before the crash instead of during the crash. They remove the very liquidity that normally prevents total collapse. Druckenmiller isn't just protecting his own portfolio, his exit, combined with thousands of other institutional exits, is removing the safety net that would normally catch falling prices. And here's what you need to understand about your position right now. If you're holding Nvidia or other expensive tech stocks, you're essentially making a bet against some very uncomfortable facts. You're betting that Druckenmiller is wrong about the 2026 timeline. You're betting that the refinancing wall won't impact corporate profits. You're betting that AI spending continues accelerating forever without any pause. You're betting that the market somehow maintains its current valuations, even as economic conditions deteriorate. Most importantly, you're betting that you'll be smarter or faster than everyone else when the selling starts. You're assuming that when the crash begins, you'll recognize it early and execute your exit before prices gap down. But history shows that retail investors are almost always the last to sell. You're getting your information from the news, which reports what already happened, while the smart money is acting on what they see coming. According to research from Dalbar Inc., which studies investor behavior, the average retail investor underperforms the market by roughly 4% annually, primarily due to bad timing, buying high and selling low. During crashes, that timing gap widens dramatically. Retail investors typically sell after stocks are already down 30 to 40%. Locking in catastrophic losses, while professional investors sold near the top. You're competing against people like Druckenmiller, who have 40 years of experience, access to private information, relationships with CEOs and policymakers, and sophisticated risk management systems. The idea that you'll somehow time your exit better than him is, statistically speaking, almost impossible. So, let me be direct about what your options are right now. Option 1. You can ignore this warning. You can tell yourself that this time is different, that AI is a genuine paradigm shift, that justifies any valuation, that Druckenmiller is just being overly cautious, and that you'll be fine holding through whatever turbulence comes. History suggests this ends badly for you, but it's your choice to make. Option 2, you can acknowledge what the smart money is telling us through their actions. You can recognize that when legendary investors who predicted the AI boom now exit completely, they're seeing something that hasn't shown up in the headlines yet. You can follow Druckenmiller's lead by protecting your capital now, accepting that you might miss some upside if the rally continues for a few more months, but preserving your wealth for when assets go on sale in 2026. Think about the risk-reward calculation here. If you stay invested and Druckenmiller is wrong, maybe you make another 10 to 20% over the next few months before the top. If you exit now and Druckenmiller is right, you avoid a 50% drawdown and preserve $50,000 on every $100,000 invested. The asymmetry is obvious. You're risking catastrophic losses for modest potential gains. Here's what protecting your capital actually means in practice. It doesn't mean selling everything and hiding under your bed. It means recognizing that we are late in the cycle and adjusting your portfolio accordingly. Maybe you reduce your tech exposure from 60% to 30%. Maybe you take some profits off the table and move to cash or treasury bills that now yield 4 to 5% with zero risk. Maybe you add gold or defensive sectors that historically outperform during recessions. The specific allocation depends on your personal situation, but the principle is universal. Stop chasing the bubble. The smart money has already rung the bell at the top. The distribution phase is complete, and you have a brief window, maybe a few months, before the reality they're positioning for shows up in economic data and market prices. According to Nobel Prize-winning economist Robert Shiller's research on market bubbles, the warning signs are always visible before the crash, but most investors ignore them because the short-term trend still looks positive. Prices keep rising even as the foundation crumbles, creating a psychological trap where investors mistake momentum for validation. Then when the turn comes, it happens faster than anyone expects because everyone realizes simultaneously that they need to exit. We're in that late-stage bubble phase right now. Prices are still rising, analysts are still bullish, and retail investors are still buying. But the foundation is crumbling. Corporate insiders are selling. Legendary investors are exiting. Refinancing stress is building. The AI ROI cliff is approaching. And the liquidity that normally cushions crashes is already gone. Druckenmiller has given you a gift with his Q3 2025 filing. He's shown you exactly what the smart money thinks about the current market and where they're positioned for 2026. Most investors will ignore this signal or rationalize it away. They'll find reasons to believe that somehow they know better than a billionaire with a 40-year track record of navigating bubbles and crashes. Don't be that investor. Don't be the liquidity he used to exit. Don't be the person who wakes up in mid-2026 wondering how they missed all the warning signs that were right in front of them. The clock is ticking. The smart money is already gone. And the question isn't whether a reset is coming. It's whether you'll position yourself to survive it or become another casualty in the greatest wealth transfer of the decade. Your money, your decision. But now you know what the billionaires know. What you do with that information is up to you.